Thank you for staying with us. Well, we've talked about this, the central bank's position on benchmark interest rate at 27.5%, following conclusions of its monetary policy meeting, which held last Tuesday. This is the third MPC meeting of the year and comes after the CBN aggressively raised rates by 700 basis points earlier in 2024 to combat rising inflation and volatility in the exchange rate. The bank also retained the cash reserve ratio at 45%, liquidity ratio at 30%, citing improved macroeconomic indicators. According to the CBN governor, the decision to hold rates was unanimous among committee members and shows sign of easing inflation, increased foreign exchange inflows, and a more stable naira. The latest data from the National Bureau of Statistics shows headline inflation moderated to 22.2% in June, down from the previous highs. The moderation, while partly attributed to recent rebasing of the Consumer Price Index, is also as a result of tight monetary policy conditions and exchange rate stability measures implemented over the past 6 months. My next guest is Dr. Ayodeji. He is the Managing Director, Chief Business Officer of Optimus by AfroInvest. Dr. Ebo, I must thank you so much for sparing our time this afternoon.
Good afternoon. It's great to be here.
Yes, I think it's always good to have your thoughts first generally about the outcome of that meeting.
Yeah, so I think the outcome came as a surprise to me because my position is that we should see a rate cut. But I also understand, so a rate cut was between 25 basis points to 50 basis points was my expectation. But I believe that looking at things, the CBN is really happy with the stability the economy is enjoying and will not want anything to tamper with the equilibrium points. I know there's still room for improvement, but given where we're coming from in the last 1 to 2 years, it's really a sign of relief to the monetary policy authority. So I think in that light, I would align with their position. Secondly, you also look at inflation rates. So while inflation, which is the new or the rebased inflation rate, seems to be tapering down at 22.2% as at June, the month-on-month is still growing. That was around 1.9% compared to the previous month. And you particularly look at food inflation. Food inflation at 3.2% is also significant when you analyze it. So it's not a time to begin to just cut rates for the sake of it. We've also seen that without even the rate cut, the Debt Management Office, DMO, and CBN has been able to bring down Treasury bills rate. So you look at yield that started as high, it's as high as 26%, is less than 20% within the Treasury bill space. So being able to achieve that even without necessarily cutting the MPC rate is also a positive one. So by and large, I think that it's in order, and I feel that we'll just it's just to give more time for the CBN to see the trend that inflation is able to achieve, to see the FX rates, if the stability will also be able to be sustained. We know the school fees era for September, when the market is also watching, will there be pressure on the naira? So if we're also able to weather that storm, then it provides a bit of comfort even to a lot of the market participants.
Let me take you on that, talking about portfolio investors being attracted to Nigeria, considering the stability in our currency and all of that. Analysts like you would also say this is called hot money. And how long are we going to continue to, stay with hot money? What positives would that have for us? Because if there's any change or any flip, these guys will move this money as quick as they can. Considering the fact that we will have a stable external reserves at this time, gives them more confidence.
Okay, thanks. Yes, we call it hot money because of the short-term nature of the funds. However, it's about the liquidity. So as long as the economy is not fully dependent on FPI.
Okay.
There's a need. They provide that short-term liquidity that you need while you're working on the FDIs that will provide the long-term stability. So there's a need to have the mix, and it's always better. An economy will develop more if you're able to achieve a higher mix of FDI relative to FPIs. So there's a need for us to have the FPIs to also provide that short-term liquidity. If you come back to the Nigerian stock markets, reason why we've enjoyed a bit of stability to the upside in the last 3 years is because it's majorly directed by domestic investors. Transactions carried out average of 70–80%. So when there's any major shock globally, even if the foreign guys are trying to sell, it's not impacting significantly on our market. It's positive, but we also know that no market can also grow on its own. There's a need to also have that mix or injection of FPIs play in the equities market. Based on the data as at, I think, May or June, is about 30%, which is almost double of the proportion we had last year, which is about 15% participation in our market. So I think the FPI is needed, but the economy should not depend significantly on it. We need that short-term liquidity of foreign investment while we are working on the long-term FDIs, which provide long-term stability. You know, it's also good to note that to attract FDI is just beyond rates. It's just beyond FX stability. There's a need to see a blueprint, stability around the economy. How are we in terms of enforcement of contract, insecurity, because they are playing long-term, trying to settle. So those are factors, the infrastructure bottleneck. These are things that foreign direct investors will consider before making that long-term commitment into investment to any country.
So moving on, with this reduction, or what would I say, we see this decline in inflation, though not as much as many would want, considering the rebased CPI, and even do you think that we've gotten to that point where that curve is coming downwards? That's one. And do you think that would form a major decision at the meeting in September?
Yeah, so I think that it should inform that, because first of all, we would have also been able to establish a trend. We would have seen July, August before the September meeting. So if the downward trend is sustained, but we need to know that there are pressure points. So you look at Q1 GDP data for the agri sector grew by just 0.1%. Means that activity within that space is not booming as expected because of insecurity. So if food inflation, you look at even most of the Benue State food producing area having one of the highest inflation rates within the food inflation rate, means there's a problem. So those are pressure points. The FX has been stable. We've seen a bit of appreciation. If that is sustained, that may be a major buffer to absorb the shock that we'll be seeing around food inflation. But we shouldn't also forget energy prices. So if the government fully removes subsidy on electricity tariff, it means that the tariff would increase across board from band A to, and maybe the gap between the band A and other bands would also be normalized. That's going to have impact on inflation. But by and large, there's a need that I feel that if this trend of moderation is sustained, we may see that cut that we, for some analysts, have been looking forward to between 25 and 50 basis points, just to signal, you know, it's good to begin to taper down that rate so that it's also responsive. You know, in past years, most times the MPR has just become just for formality, is not reflective of interest rate and is also not responsive. So now there's a need to still make MPR more relevant. They need to ensure that it aligns with what the interest rate environment is saying, so that when there's any adjustment in the future, we see that market will react to that beyond using the auctions to guide interest rate up or down.
That sounds good. We also saw the rebased GDP come up after we waited for some time. I don't know how that also comes to you, looking at rebased GDP, the growth, and of course, in terms of dollars, where we stand. It's an economy that is heading towards $1 trillion economy. And as at today, I think we're doing about 200 and something billion dollars when you convert that very figure that was released by the NBS. How would you also react to that?
Okay, so I think, yes, looking at the data, one thing that has been established is that in terms of the economy, Nigeria is well diversified. So the non-oil sector, which now accounts for about 94% of total activity within the economy, showing that in terms of the activities, we are diversified. It's now the FX earnings that we need to work on. Secondly, if you look at it, some of the sector, the digital content sector that have not been captured in the past have now also been added. So we're seeing that shift to the non-oil sector economy. But one thing, like I think I highlighted it earlier, is that the agriculture sector, when we look at it based on broad-based, the agriculture sector is not growing and accounts for a major part of the total economy. And in terms of employment, is also still the highest employer of labor. So if you see percentage for the agriculture is currently increased to about 27% based on the new rebased GDP, but services still account for about 53%. But when you look at job opportunities, is the agri sector that will provide more job opportunities relative to the services sector. So there's a need that we have to come up with like policies that will drive down non-oil sector. The agri sector, which is number one, insecurity is still a major setback. Now, this is the period where cultivation should, I think, last 1-2 months, that cultivation should have started. If we don't cultivate enough, there's nothing to, it means it will affect harvest. And when you look at prices, when you harvest less, then the prices of things, of these items or this produce would significantly be impacted. And that would continue to reflect in our inflation rate. So while we look at the GDP numbers that, yes, we are now at above 3% based on the rebasing, and we're looking towards the north of 4%, that will also not translate. What people would say, does GDP, the question you get from the average Nigerian is, GDP will not give food to the table. And what this is simply saying is that the value we're extracting from that GDP in terms of the revenue that we would get, income that we can get, is really very low. So you would see that when you look at the budget, a major part is still being assigned to the oil sector. So there's a need to sweat, if you see it as an asset, there's a need to sweat that GDP, the non-oil sector GDP, to attract more value from it. You look at the manufacturing trade, are we adding value to the things that we extract? Or we're just exporting them in raw material and we sell them cheaply, than add value? The margin you make when you add value to a product is more than ×2 you make than selling it in its raw form. And it's not just about the money we'll make. We're all talking about employment. The rate of unemployment has continued to increase because the industries are not growing as fast as, say, the economy is growing. And the population growth rate too is almost at par now. The growth rate is almost at par. So when we talk about inclusiveness, will it translate into higher income, per capita income? It's not yet translating into it because why GDP, even if we have the $1 trillion GDP, how are we sweating? So you don't just have assets. You know, when you look at the economy as like a company, are you just having assets that you look at your return on assets and it's not encouraging or it's even negative? That's like the situation that we have, that the asset, which is the GDP that we have, is not delivering as much income or revenue that we should be getting. I know the government is working on, you look at it from the tax perspective, but there's also a value add perspective that is very important for us to be able to extract value from the GDP numbers.
Well, that's a good one. Let's see how it plays out moving forward. I must really thank you for your time, as always, and your contributions to our program. Dr. Ayodeji is the Managing Director, Chief Business Officer at Optimus by Afri Invest. Do enjoy the rest of your day.
Thanks for having me.
All right, then it's time to review figures now from the Exchange Limited, where we break down those figures. And my colleague is live in the studio, Effiong Ekop. Effiong, how's it going today?
Today is very, very good. The market is performing so very well in all the sectors.
Wow.
We see index closing above 2%. Really 2.0.